Thanks for taking time from your day to check out this video from NetPicks. And, it's no secret. I've said it a few times in my videos that one of my favorite trading indicators is the MACD, the moving average convergence divergence. It can be used as a momentum indicator. It can be used as a medium-term trend indicator. And I put together a complete video guide, and I'm not going to go into too much detail behind the MACD, except I'll say that you have a fast line, which basically measures the distance between the short and a longer term moving average. You have a slow line, generally called the signal line, and it's a standard setting of 16 period moving average of the fast line. I have a zero line, which is just a reference line, and a histogram, which will show the difference between the fast and slow line, the separation of it. So we're going to use the MACD to find divergence on a chart, and then we're going to look to enter a trade in the potential new direction. So how do we measure divergence? Well, to put it simply, we find divergence by seeing a momentum indicator go in one direction, price heads in the opposite direction. And you can use any indicator that shows momentum. You can even use the RSI if you like. It doesn't matter. The indicator that you use is not as vital as your understanding of what it is telling you. So on all of these charts, we're going to use the default MACD settings, which is 12, 26, and 9. And we're going to set them all to EMAs, exponential moving averages. And some platforms, I don't know what you all are using. Some you may not be able to adjust much of the settings, okay? So on this chart here, we see price put in a lower high and a lower low, and that's a pattern for a downtrend. But if you look at the MACD, we're actually seeing new highs being made both in the lines and in the histogram. So what this shows is a change in the momentum of price to the upside. And the reversal candle that's followed by momentum to the upside on the next candle confirms that indeed we had divergence here. So when price is moving down, but momentum is moving up, we're going to call it bullish divergence. So this is going to be bearish divergence. So price is making new highs and new higher lows. That's an uptrend. Now that last push into highs, that's a full body candle. That shows momentum in price. But if you look down at the MACD, we actually see bearish divergence setting up, and that's confirmed by lower prices. So the key point, divergence is a momentum indicator heading in a direction that is opposite to the direction of price. It's pretty simple to see, right? So now you understand what that is. Let's look at that, how we can use it alongside some price action. So we want to understand the idea of what we're trading. Okay, so it's the MACD is showing momentum in the current direction, right? And then we see a reversal of price in the direction of the change in momentum. Okay, so this is a daily chart of Facebook. Now, I'm not going to cherry pick the best examples because that's not how most price looks. But I want to make sure we cover a few different situations. So here, price put in a higher high in price, right? The MACD is showing weakness in the upwards momentum. Now this chart actually gives us a consolidation at highs that we can look to trade to the downside using any sort of range trading strategy or breakout that you want to use. Now you can mix and match anything in trading. So don't get stuck thinking that there's only one way to trade something. Like I'll often use smaller time frame ranges to get involved on a higher time frame pullback. Okay, so with this range, we're going to be hunting downside breaks with the support of bearish divergence. Now, just using an upsloping trend line, a trader can look for price to break the trend line. You can find an entry in that location. So in this example here, we have a break, a gap down in price, and a one-day consolidation that a trader can position in, right? That's what an inside bar is. It's consolidation on a lower time frame. So the key point, ensure that you have trend line drawing rules that you can repeat. Okay, don't keep changing how you draw your trend lines. Now, this is a currency chart using the daily time frame, and I'll be honest with you, daily time frame is my time frame to trade. So this chart set up a perfect reversal candlestick along with bearish divergence. Now, there's a pullback in price that you can see with the circles. But we actually get momentum confirmation to the downside in the MACD as it puts in a lower high, as did price. So key point, A candlestick reversal can be used as an entry into a divergence trade, and this one is a perfect one. Now, divergence is not an absolute, okay? It's just a tool, and it's not always going to show up when reversals happen. This is a day trading time frame of silver futures, right? I think it's a 5-minute chart. See, price makes a higher high, right? The MACD continues to head upwards. So a trader that's only looking for a divergence setup would have missed this down move. And this is not the point of this video, but this is actually a complex correction in a downtrend. And it's a clear trading opportunity. It's an A to B equals C to D move. Now we have to have targets and stops. And there's a whole lot of different ways to set your targets and your stops. Okay, and there's plenty of examples of how to do that on our channel here. So this is the United Airlines stock chart. So in this chart, we see higher price highs, but then we see equal highs in the MACD. So the fact that the MACD could not make new momentum highs as price is making new highs, we're going to treat that as if divergence sets up. There's a few different trade examples on this chart. At number 1, price broke the previous swing high, and oftentimes you just consider that to be short-term resistance. You know, candle high, candle lows. So if price breaks back below the zone, as shown by the black horizontal line, traders can sell stop below the low of that candlestick. And number 2, prices continued to decline after our bearish divergence and the failure of high occurred, right? As price reclaimed that resistance level. We see an inside bar, which, as I mentioned, is a lower time frame consolidation. You can play a break of that candlestick on this time frame, which is essentially trading a breakout on a smaller time frame. This green line, it's an obvious swing level that could act as support. This would be a good zone to adjust your stop, scale out partial positions if that's what you do, or just get out of the trade. Your stop loss, you can keep those in tune with the actual setup. So what does that mean? Well, with divergence, we're going to have a pivot level in price because we're looking to trade at reversal points. So this is a 5-minute stock chart of Apple. So for traders who have smaller accounts and you can't trade higher price stocks like this, consider looking into trading options. Okay, so for this, you could buy a put for this type of trade. That would have you controlling 100 shares of Apple stock for a fraction of the price. So divergence is in play here. We have a 3-bar triangle set up after price highs were rejected. So if you're trading this short, your stop loss could go slightly above the high of the pivot, because if this trade is going to fail, the failure would be a continuation to the upside, and we would definitely want to be out of this position if and when that would happen. The key point there is consider placing your stop where your reason for the trade would be invalid. Let's wrap it up with a conclusion, and there's nuances with this in any trade you are considering, right? And those can only be covered during your initial work on the strategy, right? And you may add some discretion that I didn't even consider, and that's going to make any strategy uniquely your own, which is really important. But what is not a nuance are the absolutes that are needed for any strategy. And for our divergence strategy, price has to make a new high or a new low. MACD must make a high or a low in the opposite direction of price movement. We need a trigger into a trade. Okay, and whatever you use for an entry trigger, that's up to you. Your protective stop loss has to be adhered to. Okay, you want to prevent losses greater than 1 times your risk. And you need an exit for profits. You can use trailing stops to fix targets. Again, those are for you to decide. And I know some traders that take all the position off at 1.2 R. So just a little bit more than 1 times the risk. Divergence trading could open up new doors for you. Okay, but just remember that we're trading price movement and not any indicator. The indicator should be supporting information for your trading decision. Hope you grab something from this video. Divergence is a nice little tool to have. It's not flawless, of course, and that's why we need protective stops. Thanks for watching. Make sure you hit like, subscribe. Good trading.